In today's episode, I'll talk about three interesting stories. In the first story, I'll talk about TCS's latest quarterly results and why it holds importance to people like you and me as investors and for people who track the markets. In the second story of the day, I'll talk about the progress that millions of Indians at the very bottom of the socio-economic ladder have made, especially in the rural parts of our country. And in the third and final story of the day, I'll talk about the changes in regulations for investment advisors in India. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Monday, the 13th of January. Let's begin with the first story and talk about what exactly is happening with TCS, which is India's largest IT services company. Now, the reason I'm talking about this today is because TCS recently released its quarterly results, and considering the company's size and scale, it gives us a great insight into the IT industry of India. Now, in the latest quarterly result, TCS reported revenues of 63,900 crore rupees and a profit of about 12,300 crore rupees. TCS basically earned a little bit more money than they did before, and their profits also went up by about 12%. Another good news here is that they won new deals of about $10.2 billion during this specific time period. And what is even more interesting is that these particular deals did not include any huge or mega contracts. Instead, they were all made up of relatively smaller deals, which slowly added up to become a big number. Now, the situation usually points to a more stable and long-term growth because it means that many different customers are actually choosing TCS rather than one or two very large players. Also, if you look at where exactly TCS is growing, our country shows a very interesting rise of about 70%. Now, that sounds huge for sure, but a big part of it comes from a major project that TCS is doing with BSNL. Now, that project, for your reference, is around 70% completed now, so it definitely won't keep pushing the numbers much in the future for them. But meanwhile, for TCS, Middle East region grew by 15% and Latin America grew by 7%. But in North America, which is by the way TCS's largest market, it actually went down by about 2.3%. The European region also saw a small decline, and that means TCS did not perform equally well in every part of the world. But if you break it down by industries, TCS makes the most amount of money from BFSI, which is by the way banking and financial services, and this is an area that brings in about 30.5% of TCS's revenue, and it hardly grew this time around. Coming to consumer businesses, it did a little better for TCS and grew by about 1.1%. But communications fell quite sharply and dropped by about 10.6%. Manufacturing, on the other hand, which used to do well in the past, barely went up this time around. Technology and services also slipped quite a bit. So if you look at it from a 30,000 feet level, the overall numbers are decent for sure, but every industry probably has its own share of problems. Now, some people are trying to figure out the reasons behind these mixed results. One major factor is a set of changes that the IT industry might be facing very soon. Now, a recent report by Bank of Baroda highlights 4 of these changes. The first is Donald Trump returning to power in United States. Now, when this happened, there could be changes like visa rules which allow Indian professionals to work in the US. Now, such policy changes could increase costs or make it very hard for Indian firms to do business as a whole. The second factor here is the belief that interest rates might stay high for a longer period of time. Now, high interest rates, for your reference, usually mean that businesses become more cautious with their spending, especially areas like banks and industry which heavily rely on loans or large amount of capital. The third reason here is that a lot of companies during the pandemic have rushed to upgrade their technology. Now, consultants at Accenture call this compressed transformation. Basically, instead of slowly modernizing systems over 5 or 10 years, businesses actually ended up doing it in 1 or 2 years. And now they are suddenly starting to take a breather, which basically could explain why IT spending might be slower right now. And the fourth factor is artificial intelligence or AI. Now, this of course is creating a lot of excitement across the world. Practically everyone around us is talking about it, especially about Gen AI or generative AI, which can generate text, images, and other content on its own. But there is a suggestion that in the near term, AI might actually start to put pressure on prices because companies are not too sure if they will see quick returns on what they spend. We are also seeing a shift in how customers pay for IT services now. It's no longer just about saving money by hiring hiring people in places with cheaper labor. Instead, more customers want to pay based on the actual results that they get, like how much a new system helps their sales and so on and so forth. And this means that IT companies have to split big projects into smaller and more manageable parts which show clear benefits. Now, talking further about AI, TCS mentioned something called the agentic AI, and this suggests AI solutions that can do more than just chat or answer basic questions. But of course, that said, there's a lot of hype around AI as well, and it's not very easy to differentiate what is truly useful and what is not. Now, many people on one side think that AI could change the entire IT industry by letting software do many of the tasks that us humans do today. But no one is, of course, completely sure of how fast or how dramatically this could happen. Now, on the people front, TCS's attrition rate, which basically tells us how many employees are leaving the company, went up a little bit to about 13%. They also reduced their total headcount by 5,370 employees, which brought their workforce to about 607,354 people. Now, this might sound alarming to some extent, but it can also mean that TCS is reorganizing and becoming more efficient as an organization overall. Because nowadays, revenue growth does not always come from hiring more people, because technology can help existing employees do much more than they did before. Another big question here is whether TCS and the entire IT industry will change how they charge their customers. See, traditionally, IT work is billed by the number of hours put in by staff. But the thing is, with AI, it could push companies towards charging for software-based solutions or fixed price packages. Now, currently, TCS says that they aren't seeing that switch happen widely, but everyone is keeping an eye on how AI might actually change their business model almost drastically and completely. But all said and done, despite all of these factors, the TCS management sounds optimistic. They feel good overall about the kind of deals that they are signing, and they mention that clients seem to be making decisions more quickly than they ever were. TCS management also hinted on the fact that spending on discretionary or extra projects might pick up in the future, especially in areas like banking, financial services, and retail. They even suggested that 2025 might be a much better year than 2024 for the entire IT industry. So looking ahead, one very important question is how exactly TCS will make up for the end of the big BSNL deal once it is fully done, as I spoke about it earlier. And of course, the race to add AI into everything will test how quickly TCS can practically evolve without hurting the business that it already has. With that, let's move on to the second story and talk about a very important piece of news that usually gets ignored in our daily conversations. See, I'm sure you've noticed how people usually talk about startups, electronics, manufacturing, etc., and how it is changing the Indian economy. But the thing is, there is another story which is relatively less talked about, but this might be even more significant when you look at how many lives it touches. This story is about the progress which millions of Indians at the very bottom of the socio-economic ladder have made, especially in the rural parts of India. Now, a research by the State Bank of India says that India's poverty levels have dropped very sharply over the last decade. To understand what this truly means beyond the headlines, we need to go back to 2011-2012. See, at that time, the government set a basic poverty line. Now, this means if you earned less than 816 rupees a month in a village or 1000 rupees per month in a city, you were considered poor. Now, it turned out that a quarter of India's rural population and nearly 14% of people in cities fell below that line in 2012. Considering those numbers, it was quite an alarming situation back then. But last year, India completed a new survey of household consumption, which is called the Household Consumption Expenditure Survey, or HCES. Now, when we take the old poverty line from 2012 and adjust it for the rise of prices, we find that the percentage of Indians who are still living below this updated line is now below 5% in both rural and urban areas. So in very simple terms, very few people in the country are now living as poorly as we once used to define poverty about a decade ago. And this is big news because it shows a very clear improvement in the living standards of the poorest of Indians. But some experts are still very cautious about this. They are arguing that the poverty line that we have used might be too low to capture everyone who is actually struggling. If we actually raise that line a little bit in order to match to what other middle income countries consider as poverty, we might find many more Indians below it once again. Even so, by the standards that India set in 2012, the number of people in extreme poverty have fallen a great deal for sure. Another remarkable part of the story is that rural areas have seen some of the biggest changes ever. 10 years ago or so, poverty was about twice as common in villages at about 25.7 than in cities at about 13.7. But today that gap is almost gone. Urban poverty is about 4.09%, while rural poverty is only a little higher at about 4.86%. And that means more and more people in villages have actually managed to escape dire conditions that we once used to see very, very often, and that has brought rural living standards much closer to those in the cities. Now, one obvious reason for this could be better infrastructure like roads, etc. Basically, when roads connect a village to nearby towns and cities, it becomes much easier for people to travel for work, to buy goods, and to access government services as well. Over the past decade or so, India's road network has grown quite a bit. The length of national highways has gone up by about 50% since 2014-2015, and more than 7 lakh kilometers of road have been built under the PM Gram Sadak Yojana. This makes a big difference because improved connectivity can practically entirely transform a village's economy almost overnight. Government schemes have also had a big impact. These include distributing free food grains, sending money directly into people's bank accounts, and helping farmers increase their income. Because when rural households have more money in their hands, or they know that they can get food without spending too much money, they can actually start using their resources in order to buy other things. And over time, this allows them to move beyond just scraping by on a day-to-day basis. Also, as rural India becomes a little more better off, people's spending habits also start to change. About 10 years ago, more than half of the money that people spent in villages went towards food alone. Now that fraction has dropped slightly, and people are now able to buy items like toiletries or pay for transport more often. And at first, this might not sound like a big deal to you, but it actually shows that many rural Indians are no longer living hand to mouth. They have extra money in order to spend on something apart from just the next meal. And all of these changes mean that hundreds and millions of people who were once too poor to even participate in the economy are now slowly becoming meaningful consumers. They still might not have a lot of money, but even small changes in their spending can add up to a big impact when you look at India as a whole country. And this is one reason why companies that sell everyday products like HUL, Dabur, etc. are very excited about expanding in rural India. Reports say that their rural sales have been growing more quickly than their urban sales in the recent times. So in short, when we talk about India's growth story, we definitely should not forget this quieter but more powerful shift in the grassroots level. Decent roads, targeted government help, and higher incomes have all combined to lift millions and millions of Indians out of the harshest levels of poverty. Yes, there are still questions about how exactly we can define poverty. The fact is that there is no denying that a big transformation is underway in our country. With that, let's move on to the third and the final story of the day and talk about a very interesting shift in India's investment scenario. See, not too long ago, in about March 2021, the total number of registered investors in India was about 4 crore people. Now, that figure took about 25 years for us to reach. But then things accelerated in a crazy way. Over the last 3 years ever since, it has shot up to 11 crore people, and each new crore of investor is joining at a faster pace than they ever did before. Now, in some recent stretches, it only took about 5 months to add 1 crore extra investors in our country. And this sounds like a dream for a growing market, right? Because more and more people are learning about stocks and mutual funds, opening up trading accounts, and showing an active interest in building their own wealth. But here there is a worrying twist. See, at a time when the investor base is expanding heavily, the number of people who are qualified to guide these new investors, which are registered investment advisors or RIAs, is actually going down. And to understand why this is exactly problematic, we'll first need to understand who RIAs exactly are. See, RIAs or registered investment advisors are professionals who are licensed to offer paid advice to investors. Now, the purpose of having a license here is to make sure that advisors follow specific rules that safeguard investor interests. They basically guide people on where to invest, how to plan financially, and how to avoid unnecessary risks. Now, as and when more first-time investors enter the market, the need for quality advice becomes even more critical. But here is the reality. In 2021, there were 1,334 RIAs in our country. But by August 2024, that number has actually dropped to 927. And if you account for those who mainly provide trading tips for derivatives like futures and options, etc., the pool of advisors who are offering holistic financial planning might be barely around 200. And mind you, that is 200 advisors for 11 crore investors, and that is a massive imbalance. And if you're wondering, there is a very clear reason why RIA numbers have been falling. See, until recently, the rules that were set by India's capital market regulator or SEBI were so strict that many advisors found it tough to either get or maintain their licenses. Being an RIA meant meeting high net worth requirements, fulfilling specific education criteria, and also navigating rules which seemed to get more complicated as time progressed. Now, while strict guidelines are a good thing for investor safety for sure, the problem is that they can also push many genuine professionals away from becoming advisors in the first place. So recognizing this exact issue, SEBI has now introduced some important changes to the RIA framework. Now the idea here is to make it easier for qualified professionals to become advisors while they still keep investor protection as a top priority. Now one major change here is a shift from a high net worth requirement to a system where advisors put a deposit instead. See, in the past you needed a net worth of at least 50 lakh rupees if you were a firm and about 5 lakh rupees if you were an individual. But today SEBI asks for a deposit of only 1 lakh rupees if you plan to have up to 100 clients. Now this deposit of course goes up with the number of clients, but it is capped at 10 lakh and that only applies to larger firms with more than 1000 clients. Now another very encouraging development here is in educational requirements. See, before you needed a postgrad degree or a professional qualification and also relevant work experience to become an RIA. But now a graduate degree is enough and there is no mandatory work experience. Of course, advisors still need to clear certification exams that are conducted by the National Institute of Securities Markets or NISM, but they only have to take a refresher exam once in every 3 years. This is meant to basically ensure that advisors stay up to date without putting them through repeated full-length exams every single time. SEBI has also, by the way, adjusted the fee structure over here. See, advising investors can be a very costly affair if the fees are set too high or too low for that matter. So therefore, finding the right balance is very important here. The maximum fixed fee that an advisor can charge per family per year has been raised from 1.25 lakh rupees to 1.51 lakh rupees. Advisors can choose between charging a fixed fee or charging based on percentage of the assets that they can advise on, and they can switch between these methods whenever they see fit. Now, there's yet another rule that SEBI has relaxed, by the way. Previously, an advisor with more than 150 clients had to set up an entirely new company altogether, which basically added a lot of layers of paperwork and expense as well. But now, that particular threshold has increased to 300 clients or 3 crore rupees in annual fee, whichever comes first for them. This, of course, gives smaller advisory practices more space to grow before facing obligations of becoming a corporate entity. Now, all of these changes are designed to strike a healthier balance between protecting investors and also making sure that advisors can run their businesses without any unnecessary hassles. It all opens doors for more professionals, especially younger people who might want to become RIAs in the future. Now, for an investor like you or me, this should be great news because it helps create a large pool of advisors who are actually trained and regulated. And it also makes professional financial advice a lot more accessible. With that, let's move on to the final section of the day and talk about the quick news stories. First, NHPC India, which is the largest hydropower generator, plans to acquire the combined 16.2% stake held by its public sector co-promoters, NTPC, Power Grid, and Power Finance Corporation. Each promoter holds approximately 4.05% in PTC India, which has paid over 320 crore rupees in dividends since its inception. Second, Emami has now rebranded its 2-decade-old male grooming brand from Fair and Handsome to Smart and Handsome in order to capture a large slice of the expanding 32,000 crore rupee male grooming market. Currently, the company operates in a limited 700 crore rupee segment, which is dominated by creams and face washes. Now, this rebranding allows Emami to launch diverse products which are aligned with shifting consumer trends because young men are now increasingly using an average of 5 grooming products every single day. Third and the final one, Swiggy recently announced that its quick commerce service Instamart will soon operate as a standalone app while also remaining accessible on the main Swiggy app. Currently serving 76 cities, Instamart offers 10-minute delivery for over 50,000 products and it is projected to reach over 100 million users as stated by Swiggy's MD and Group CEO Sriharsha Majeti. That's all the news and stories I have for you today. I hope you enjoyed the show and maybe learned something new from it today. As usual, this is your host Anurag Bansal signing off. Take care and I will see you in the next episode. Bye-bye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.